Hey, it's Patti Scharf, CPA and co-founder of Catching Clouds, the leader in e-commerce accounting. Today I want to talk about whether or not the 2018 tax law changes affect when you can deduct your inventory. I've been asked this question over and over and over this year, and I think there's a lot of confusion around the topic. In fact, I've even talked to other CPAs, and there are mixed answers. So I'm going to give you my opinion and kind of walk you through my thought process and stuff, and hopefully it will help clear some of the confusion, okay? But before we get started, I want to say that I have done taxes for years, but I also have not done taxes in years. So make sure that for your own personal situation, you go talk to your own tax advisor. Okay, so let's get started. Why do you even care about this? Like, what's the whole point of knowing when you deduct your inventory? So let's say you're selling online and you sold $1 million this year. And this year you also went and spent $400,000 on product. So you bought a whole bunch of product, you went online, you sold it, you might have some left over. Chances are if you're selling that much, you probably have some left over. So knowing how much you can deduct means, like, if you can deduct the whole thing, then your taxable income is $600,000, just for an oversimplification for this example. Taxable income would be $600,000. If you can't deduct any of it, your taxable income is $1 million. So that $400,000 of income that you get taxed on is a pretty big deal. The other reason you want to know is when you have a good handle on how much inventory you're able to deduct, you can start paying attention to whether you're making profit on your specific sales, because you don't want to be in a position where you are losing $1 per sale because you can't make that up on volume. It just like drowns you faster, okay? So that's why you care about when you can deduct your inventory. So what is inventory? And I feel like you can't really talk about inventory without talking about cost of goods sold. Those two go hand in hand. Inventory are those product purchases I was just talking about. So if you bought $400,000 worth of product, that becomes inventory. It stays inventory until you sell it. When you sell it, that's called writing it off. It's called expensing it. It's called a deduction. It is your expense. So the $400,000 becomes cost of goods sold. Inventory and cost of goods sold are seesaw amounts. You spent $400,000 no matter which way you look at it, but maybe you have $300,000 still in inventory and you sold $100,000, or maybe you sold $300,000 and you still have $100,000 left in inventory. These two amounts always balance out and match the amount that you spent in cash. The next concept you need to know about is cash versus accrual. These are two different accounting methods. I did a whole video on how to determine cash versus accrual. So go check that out if you aren't familiar with it. Now, let's go on to the 2018 tax law changes. Now, the biggest change, and this is what has everybody kind of in an uproar, is the gross receipts test. Now, what this is it says, hey, here's what it used to be. Hey, if you have $5 million in gross receipts, so basically you've collected $5 million from your customers or more, then you have to be accrual basis, which means you have to record everything on the accrual method. If you're under that, you're a small business, you can use the cash method. It's easier. You don't need to worry your pretty little head about it, okay? It was actually, the limit was 1 million if you're an inventory-based retail business. So there are a lot of people that were like right at that million mark or just above, and they were having to file using accrual-based method, and they're kind of grumpy about it, okay? So what happened with the tax law changes is that the limit got bumped up to $25 million. So that's a pretty big jump. And a lot of people who are right in between that million and 25 million went, yay, now I can be cash basis. And so everybody's thinking, yay, I can now deduct my inventory when I buy it, not as products are sold, because I'm on cash basis. And so that's how that works. The problem is, in this new law, it says if you have non-incidental materials and supplies. So things that aren't really your core product that you're selling. Maybe it's a sleeve that, you know, you include for packaging, or, you know, it's not really what what your customer is buying. It's just part of the fluff around it. That stuff, yes, you can deduct it. Or it says it follows the taxpayer's method for financial statement purposes. So what does this mean? When I first heard this and people were like, yay, I get to just deduct whatever I want to when I buy it, just in my gut, it just doesn't feel right, because the nature of cost of goods sold is it is literally cost of goods that are sold. So if you don't sell the goods, there's no cost related to them. So I really, in my heart, think that this change of threshold, saying above this your accrual basis and below it your cash basis, has nothing to do with the amount that you record as cost of goods sold. Basically, your cost of goods sold just has to match up with whatever method you're choosing for your income. So if you're reporting your income in 2018, the costs related to those sales needs to be included in 2018. If you are reporting income in 2019, the costs related to that income needs to be reported in 2019. You can't like mix and match that way. It's just not what the nature of cost of goods sold is, in my opinion. With that said, I asked a whole bunch of accountants because I heard a lot of sellers saying, oh, well, I talked to my CPA and they said, yeah, that's legit. And I'm like, okay, well, I'm not signing your tax return, so do whatever you feel comfortable with, but I just don't think it's right. I've heard that there's going to be more clarification coming on, or maybe people are just hoping that there's going to be more clarification about this. But I think there's some confusion out there about when inventory can really be deducted. I would argue that these new tax laws change nothing, and you just have to report your cost of goods sold when the goods are reported as income. Others may have another opinion. If you have another opinion and a good argument why, go ahead and leave a comment down below. I think this is an interesting case, and I think it's weird. So I think it's worth discussing. I like to discuss weird things. So I guess that's it. I hope you found this video helpful. If you did, please like, comment, and share. If you haven't already, please subscribe, and I'll catch you later.